I'm Patrick Mispagel, MD for Sustainable Finance at Moody's ESG Solutions, and will shortly be joined by Rahul Ghosh, MD for Outreach and Research, also with Moody's ESG Solutions. An important note, while Moody's is, of course, very well known for its credit ratings from Moody's Investor Service, just to highlight that, again, we're from Moody's ESG Solutions. And just by way of context, just to introduce you to who we are, we bring together over 30 years of ESG expertise to meet what is, as many of you know, a very rapidly evolving market as it relates to ESG. And understanding the evolving needs of the market is critical to our ensuring that we're delivering the data analytics and insights that will really not only serve our customers, but also really help to move the market forward. You can see on the right the way that we're organized around 5 business lines, including ESG measures, climate solutions, SME solutions, indices, and sustainable finance. And we'll touch on some of these as we go through. It's very much relevant to the topic at hand today as we think about integrating risk management and serving the markets. So with that, we'll dive into our agenda. There are really just 3 points that we want to cover in some depth. And look forward to continuing the dialogue in the Q&A, focusing on the data challenges and path to harmonization, probably issues that many of you perhaps struggle with in your work, integrating risk management and modeling techniques with some interesting case studies, and then innovation in sustainable finance products. So with that, setting the context, I think for anyone who has spent even a little bit of time in the ESG space, you have probably noticed the heightened focus. Virtually every paper, every website you visit has a headline about how various sectors, regulators, other government parties, NGOs are really focusing with heightened scrutiny on climate change and a host of ESG factors. What you see on this slide is really what that looks like in the numbers. The percentage of assets invested sustainably on the left, and the center, sustainable bond volumes, and on the right, the spend on ESG content and indices. As you can see, all growing at a very steady clip. And we'll talk a little bit about what's behind that, what's driving that, and how we think that will shape the market and how we look at risk. There's no question ESG will be the dominant theme shaping financial markets and the financial industry over the coming decade. A recent study by BlackRock estimates that almost 40% of global assets will in fact be invested sustainably compared to today's levels. And this rises as high as approximately 50% in EMEA, where, as many of you probably know, the sustainability movement has been well underway for some time. The sustainable market is forecasted to reach as high as 650 billion, and we'll go into a little more granular detail in that shortly. And Moody's forecasts global issuance of green, social, and sustainability bonds, collectively the 3 primary components of sustainable bonds, will hit a record 650 billion in 2021. So the ESG content and index market are expected to keep pace as the market grows and be somewhere in the range of 1 billion in 2021, according to McKinsey. All of this occurring in a pre-standards market, which presents no shortage of challenges for those who are working in this space, and something that we're all working toward adapting to. Against this backdrop, nonetheless, there's enormous demand and rising expectations from market participants for better, more transparent, decision-useful ESG and climate data and content. And one driver, moving on to the next slide, is also the intensified focus on achieving net zero targets. And by that we mean achieving a balance between the carbon emitted into the atmosphere and the carbon removed from it. There's a major convergence and acceleration in global policies to reduce emissions, and it's speeding up and really driving demand for ESG strategies. One of the most important elements, of course, in achieving net zero is, in fact, setting a clear target and forging the right path. And this is happening collectively. As you can see on the left-hand side, considerable coverage across the G20 economies in terms of setting their targets. The Biden administration climate summit last month confirmed its target of 2030 to reduce greenhouse gas emissions by 50 to 52% from 2005 levels. The EU has formally adopted its climate law to cut greenhouse gas emissions by at least 55% by 2030 from 1990 levels. And Chinese President Xi Jinping has indicated that coal use will peak by mid-decade and be phased down under the country's 15th five-year plan. So you can see various others on the left in their targets. So again, the sharpened focus certainly drives the need for greater tools and ability to integrate the risk. On the right, you can see what I think are some pretty remarkable numbers. When you think about government commitments, they're quite striking. The UN estimates that 121 countries, 23 regions, and 509 cities, representing 68% of global GDP, have now signed up for the Race to Zero initiative. So significant tailwinds that are moving us forward in this space. And I think an important question for all of us to reflect on is, what does this look like in terms of the actual data needs and use cases? And the next slide is, there's a lot here, and that's by design to really just demonstrate how diverse and varied the different ESG dimensions are that we're considering, and how we look at the application and use of data and the analysis that draws on that data. You'll see this is broadly categorized into three groupings, beginning at the bottom with global standards alignment. So for example, looking at screening entities for alignment with the EU's new taxonomy. This is where we would have the SDGs and forming views on the 17 SDGs. Climate exposure, whether that's management of physical risk or the transition, and ESG performance. A range of different views there. Exposure to and management of ESG controversies, for example, negative screening, positive screening, different strategies and approaches that various market participants use to assess risk and to categorize and make decisions. I think one of the things that strikes me as I look at this is you see the variation also in terms of industry level versus firm level, looking at risk and information, but also at the portfolio level and down to the individual instrument level when we talk about green bonds, for example, and producing second party opinions, just as an example. So hopefully it's clear we've made the case that the need is there, the demand is there, and there's a diverse and complex set of different cases that we can focus on. But where are we on that path to having sufficient data to feed these important needs? Moving on to the next slide. Thank you, Rahul. So as this slide illustrates, we've made progress, but there's quite a distance to travel. Interestingly, on the right-hand side, you can see reporting rate for selected sectors. And with the fine print, you may not be able to see all the details, but in the left hand side, the outlier, if you will, is, bear with me, is the diversified banks at just under 90%. And that's in part driven by some of the regulatory requirements. And as you go down the right, this is not a comprehensive list of all sectors, but you can see it gradually declines as you get to the right: pharmaceuticals and biotechnology, software and IT services, and so forth. So, so definitely some distance to travel, and more data will be coming, but investors need greater granularity, standardized ESG data, analytics, and meaningful insights around which they can develop investment strategies. Better data will also bolster the ability of asset owners and managers to actively engage with investee companies in line with their stewardship objectives. And from our perspective, harmonized metrics for measuring ESG would also provide a consistent starting point from which ESG assessment companies can base their scores, analysis, and research. Really ultimately about further reinforcing the confidence in the market and greater clarity. I won't go into all of the list of data sources. There are many, and I think that that's again part of the challenge that we all are working with. We have corporate reporting, whether it's CSR reports, annual reports, 10K forms, and so forth, that we look at to gather various data points that we might be using. There are third-party open sources such as IUF, Global Union, Industrial, and data vendors, Factiva, FactSet, and so forth. And of course, direct company interaction, whether that's seeking additional information, non-confidential information, or confidential information, as the case may be, depending on the type of engagement or the type of assessment or rating that might be completed. And importantly, information from various other stakeholders like NGOs, unions, and experts, as well as information in the press. And this certainly is something that we would look at in assessing controversies and monitoring for controversies for various companies and their exposure and response. And as I mentioned, much of the data is presented in different formats and approaches with varying levels of detail. And just one interesting example that we've had in looking at a group recently of 100 companies here in Moody's ESG recently, the units for emissions data were disclosed in about 80 different ways. So you know, there were thousands of tons, millions of tons. Sometimes it's style over substance, but what it really demonstrates is some of the complexity and challenges in bringing large bodies of data in to assess and look at some of these factors, certainly across a broader portfolio. So I thought an interesting example that kind of brings that to life. So the evolution of this story very much has to do with harmonization as well as availability. And I'd like to speak a little bit about kind of the broad-based nature of this drive towards standardization in more detail. And it's really coming from virtually all corners of the market as we see it. Starting with the policy side on the left, and you'll see there's a bit of an alphabet soup here. We've put some footnotes in it. I think it's just sort of one of the occupational hazards of ESG, given the various standards and so forth that we're looking at. But EU progress on Sustainable Finance Action Plan, including proposal for CSRD, SFDR implementation, EU taxonomy, delegated acts, and forthcoming EU green bond standards in the US. Climate disclosure and social equity issues are a key focus, key areas of focus, with expected rulemaking forthcoming. And APAC activity is certainly increasing with China's publication of updated green taxonomy points toward gradual alignment with international standards and commitment to reach carbon emission neutrality, as I said, by 2060. But the harmonization of data will require a very focused and collective effort from all market players. You know, standard setters, I think, are a central part of that story, whether it's GRI, SASB, or CDP. They're working to align approaches toward a TCFD prototype, and creation of a sustainability standards board within IFRS is being contemplated before COP26 later this year. And while we focus rightfully on climate and have for some years, and it will continue to remain a central focus, it is important to reflect on the fact that we're moving beyond climate, and we have various other aspects and threads within ESG that are taking on greater prominence in terms of market interests. We have the official launch of the Task Force for Nature-Related Financial Disclosure last week, which is aimed at greater disclosure related to biodiversity and nature-related risks. I think that's a theme that we've begun to explore in our recent research. We'll have a chance to talk about that a little bit later, and something that I imagine some of you are beginning to encounter as well. In light of and understanding these challenges as it relates to data specifically, Moody's ESG Solutions is collaborating to work through market problems and develop data that can enable us to meet our global sustainability goals. We're an active member of the Future of Sustainable Data Alliance, better known as FASDA Council, active participants in the EFRAG group working on dynamic EU sustainable reporting standards. So many of you on the call might also similarly be involved. Those are important opportunities for that diverse set of stakeholders that I mentioned before that we think need to be at the table to weigh in and shape where we're going in terms of data, given how critical it is for us to meet the demands of this rapidly growing market. So this hopefully provides some useful context for data. I think the next question is then, how do we incorporate ESG risk into management, risk management, leveraging data and other tools? So I will turn it over to Rahul.
Great, thanks very much, Patrick. And hello, good morning, good afternoon, everyone. A real pleasure to be speaking with you today. And great to hear from Patrick about how the data challenge that we all face in ESG, we are starting to see that road to harmonization. Hopefully means we start to speak a common language around ESG. We all know what EBITDA is, for instance, and having sort of your equivalents in the ESG world, I think will really help to support the better integration of data going forward. But standardized data alone is not enough. When we speak to the market, we hear about, well, how do I apply this data? How do I use it to measure? How do I use it to identify risk, to model risk, and to benchmark as well? So, really to build systemic organizational resilience, which is ultimately what we want to do in this space, we need to apply ESG data to various risk measurement and modeling techniques. And what I'd like to do today is share a couple of examples of how this is taking place in the market today. Maybe before I do, I wanted to share some really interesting results for some recent analysis that we've done that talks about where we stand, particularly on data from a corporate level, from a preparers of disclosure perspective. Patrick's talked about the sort of the investor side, if you like, and how data is used. But of course, companies themselves are facing a complex web today of different standards, reporting frameworks, etc. And what we can see here is some really interesting results. So we've taken, and in our data sets, we look at how companies globally are disclosing on climate. And we looked at over 3,000 companies globally. You can see the distribution in the bottom right of the slide. And we're looking at how well are companies disclosing today in line with TCFD, or Task Force for Climate-Related Financial Disclosure recommendations. And we conducted a study between earlier this year, so from July 2020 to March 2021. And you can see some of the key takeaways in dark green on the slide on the left-hand side. And we also compared that to a similar analysis that we did a year ago. So really showing the recent change that we're seeing in disclosure around climate. And I think the key takeaway here is that overall disclosures are steadily improving across the board. And so you can see that by the dark green bars, if you like, being higher in terms of reporting rates than the lighter ones. And that indicates that TCFD is being adopted by the market, which we view very positively. But what's really interesting is that when companies are looking to take that data and apply that to strategic decisions, to how to think about transition and about future resilience, the data is still a lot weak. And I want to point out the sort of three line items at the bottom of the chart on the left. So less than 10% of companies today are disclosing on how they are undertaking adaptation activities and building resilience to physical climate risks. Less than 10% of companies today are using, or at least disclosing, an internal or shadow carbon price to really support them in their transition activities. And less than 10% are formally developing carbon transition plans. So this really shows that, yes, data is improving, but how do I apply that to my business? That's where some of the challenges still are. And that brings me back to the couple of case studies that I really wanted to share with you today. And the first one is on climate. And I want to talk to you about how companies, particularly banks and financial institutions, are translating climate risk information into financially relevant outcomes. Before I do that, let's just spend a couple of minutes talking about the complexity of climate data and understanding the impact of climate change as well. So as many of you know, climate risk can broadly be sort of split into two specific areas: transition risk, which is essentially how do we transition to a lower carbon economy, and physical risk, which is looking at the prevalence of more extreme weather over time. Each of those different areas has its own complexity. So thinking about transition risk first, what you can see from the chart on the left shows different pathways, emission pathways based on warming scenarios. The green line, which is represented concentration pathway 2.6, is essentially the path that we would take with emissions if we were to hit a 2-degree warming scenario, which is or less, which is ultimately what we're aiming for in the Paris Agreement. And the red line shows a sort of business as usual pathway. Essentially, no policies are enacted from today, and a couple of pathways in between. And what's clear there is, from today onwards, there is clear differentiation in the potential pathways that we can have, and they're going to be driven by policy and policy choices. They'll be driven by technology and the economics of technology, and whether we can scale up areas like carbon storage and capture and storage, or new green technologies like green hydrogen, as well as more established ones in the area of renewables, for instance. It will be driven by economic issues as well, population growth. And so that makes it very challenging given the sort of diversity of potential pathways. On the physical risk side, actually, there's less uncertainty short term. We know because of past emissions that changes in our climate are almost sort of locked in, if you like, at least for the next 1 to 2 decades. But what is more challenging with physical risk is really mapping that to what does that mean for specific weather events. We can't, and climate models can't today, forecast extreme weather events or disasters with any sort of precision. Historical data in this space is not going to be a good predictor going forward, given some of the changes that we're likely to see. And there are other challenges, whether it's tipping points, points at which physical risks become irreversible. For instance, if we were to see the ice sheets melt and that have an impact on sea levels, that is irreversible. Or potential ripple effects, the impact of physical risks on migration trends or food security. So a lot to take in there, but let us just say these are issues that financial actors at corporations are having to think about when they're translating climate into financial risk. And that is precisely what they're doing. We know that banks and other lenders are increasingly assessing the climate risks inherent in their lending or investment portfolios. And there is a growing need to sort of think about that, understand that, and mitigate for some of those risks as well. What you can see on the left-hand side is how we at Moody's ESG Solutions think about physical climate risks. So we look at 3 different areas, from supply chains, operations, and market risks. The middle section on operations risks, we look at 6 different climate hazards, from floods through to wildfires, and we use climate modeling to provide scores on companies. But we don't just look at the operations of the entity itself. We look at its supply chain, and we look at market risks, the countries in which it's selling its products and services, to get a really complete picture of climate exposure at a company level. And what we can see on the right-hand side is essentially how this is being used. So this chart was taken from the European Central Bank. The ECB unveiled preliminary results from its climate stress testing work just earlier this year in February. And so what you can see from all of those dots on the screen on the right, each of those represents an individual company for which they were provided climate hazard scores. In fact, they used our data from Moody's ESG Solutions to do this. And so in total, there are, I believe, around 4 million companies on that screen. And that accounts for the exposure of roughly 2,000 financial institutions across Europe. So essentially Europe's financial system. And what you can see is really interesting. So in Southern Europe, and this looks at physical climate risk exposure through to 2040. In Southern Europe, large parts of Spain through to Italy, you see a lot of red dots. That's essentially telling you that wildfire risk is likely to grow in prominence over the next couple of decades. Whereas if we go to Northern and Northeastern Europe, you see much more in the blue in the blue area. That's flooding risk, right? Which we also expect to see increase over the next 10 to 20 years through to 2040. And what the original work here from the ECB showed is that firms in both of those categories, and more generally the ones that are more vulnerable to physical climate risk, they could have 4 times as much probability of default over the next coming 2 decades than the average firm. So really does show the need for financial institutions to understand the climate risk exposure in their portfolios and think about what that means for their business going forward. Another case study I wanted to share on how data is being used is on SMEs and small and medium-sized enterprises. And this is an interesting case study because, quite frankly, the data doesn't exist today. Patrick talked about the gap earlier, and that was with large listed companies. For SMEs, we don't have that data today, or at least ESG data in any sort of form of granular form. But we can't wait for that disclosure either. So this is where we're seeing the use of new tools. And why is SME information important? Well, investors need to measure and report on ESG risks in unlisted firms, perhaps in real assets, in their private equity investments. So they need to have a more granular view beyond sort of your top 100 or top 200 companies. Multinationals as well, many of you on the call today, want to have a better understanding of the social and environmental risks inherent in your supply chain, and are demanding sort of tools to help you think about vulnerabilities in your supply chain too. Banks are lending to SMEs, and they want to be able to lend and provide sustainable finance solutions to small businesses that have strong ESG credentials. And finally, there's just a growing appreciation and recognition of the role of SMEs in meeting the SDGs and meeting the sustainability goals we have. We have to bring them on board on this story. And finally, the chart on the right that you can see is the increasing prominence of social issues, including supply chain, including supply chain issues. You can see that last year in our controversy cases, more than half were related to social issues. So it really does underscore the prominence of both social issues, but also SMEs. And so what we're seeing, given the lack of data, is new techniques, and particularly modeled data. So what I'm showing you here is actually something that Moody's ESG Solutions is rolling out itself to help address this demand for greater information on SMEs. So we're launching AI-driven, model-driven analytics. So we look at SMEs in their location, their industry and sub-industry, their size, and additional regional characteristics to provide modeled data for over 100,000 SMEs, and that's going to grow over time, providing data points. And what's really interesting, I've given you some of our modeled data on the right-hand side, is that you're seeing different trends by different regions. So the colors here essentially represent the absolute size of the SMEs that we're looking at. And you can see in Europe, generally speaking, larger companies, so those in blue, tend to have a better ESG score and ESG profile than smaller companies that are in red. And it's a relatively clean distribution. But in Asia, there's a little bit more of a skew. And in the Americas, it includes North and South America. The data is a little bit choppier as well. So really interesting for the market to take a bird's eye view of potential risk and then use this information to deep dive and do additional due diligence where they think there may be risks in their supply chains as well. So hopefully that's given you a couple of interesting case studies. Happy to talk more about those a bit later on. But with all of this data that we're seeing, I think one of the benefits, one of the value is that is going to help propel sustainable finance and lead to new innovation. Data supports innovation, of course. And we're seeing that across sustainable finance markets. And that's where we're going to sort of finish. It's our final trend that we'd like to share with you today. And then happy to take your questions. Now, before we go into the innovation that we're seeing in sustainable finance, one of the clear areas that we've seen has been tremendous growth in sustainable debt, sustainable finance more generally. And Patrick, I'll bring you in here, but you can see from this slide here just the evolution and the rapid rise that we've seen in sustainable debt over the past decade. It's been nothing short of spectacular, really.
Thanks, Rahul, and indeed, I mean, I think this in many ways mirrors where we started the discussion, just speaking about the scale of the growth, and also this teases out, I think, one of the particularly notable aspects of this, which is Q1 2021, the volumes in sustainable finance represented 9.4% of the total bond issuance versus 2% in Q1 2018. Just a remarkable growth. And as you can see with the breakdown here in the bar chart between green bonds, social bonds, and sustainability bonds, it's been a healthy clip in all three of those areas. And it remains incredibly resilient. I mean, I think our analytical teams are extremely busy on the second party opinion front, and seeing not only the increase in volume, but an increase in new flavors, if you will, of sustainability linked loans and bonds, and other innovations in the market. I think I already mentioned that Moody's forecast is that our original forecast was to hit a record 650 billion in 2021. I think there's potential that could be on the low side if the pace that we've observed continues. But indeed, the size is there, and I think certainly coming with that is the innovation. And I think, Rahul, if you could provide a little perspective on kind of what that translates to in terms of specifics and some actual examples of what we're seeing.
No, absolutely, Patrick. And just taking some time to look at this chart again, I think it's really remarkable the resilience that we've seen with sustainable finance. So if we hark back 12 months, perhaps just more than 12 months, in March and April of last year, the markets were in virtual shutdown, and there was a real concern whether the sort of growth that we'd seen in sustainable finance would endure as companies sort of had a short-term focus on cash management and frankly survival. Many companies. Not only did it endure, but we saw, if anything, a sort of renewed vigor and purpose amongst investors and companies on sustainability and financing sustainable transitions. So that's been fantastic to see. And as Patrick mentioned, one of the key trends has been the diversification of the types of structures that are out there. And sustainability linked bonds is a really interesting area. And I just want to spend a few minutes talking about some of the trends that we're seeing in this space. So sustainability linked bonds, maybe if I start with definitions. So typically the market for sustainable debt, as we showed earlier, has been driven by what we call the use of proceeds market. So essentially bonds, or the proceeds that are raised by bonds, are channeled into specific projects, whether they're assets, maybe a power plant, for instance, or specific activities that are labeled as green or social. So the issuer, as a result, is committed to channeling those funds into those projects, managing those proceeds accordingly, and reporting on those projects accordingly as well. The sustainability linked bond structure is different, however. So funds can be used for general corporate purposes from a company. So in that sense, they provide additional flexibility. But what a company essentially commits to is to essentially embedding one or several key performance indicators, KPIs, into the structure and hitting those over an agreed predefined period. And if they don't, there may be some sort of financial penalty or characteristic that underpins that particular transaction as well. So very much a more dynamic way of thinking about green and social and sustainability transactions. We think that both the use of proceeds in the SLB market will continue to thrive and complement each other. But as you can see here, we've seen tremendous growth in the past year or so, albeit from a low base. So already this year, we're probably at around $12–13 billion worth of sustainability-linked bonds. We really saw the market propel from last year in the summer when standards were put out there by ICMA. So we have the sustainability-linked bond principles. We've also seen some policy support. So for instance, the ECB now looks at these sorts of structures and can buy them as part of their corporate asset purchase program as well. One of the key observations that we've seen in this nascent market has been diversity. And you can see that in the middle. We're seeing diversity in terms of sector, the types of issuers. So it's not just sort of more traditional sectors that have issued use of proceeds bonds like utilities. Yes, they account for a decent slice of the market, but we've seen issuance from paper and pulp producers, from energy companies, from banks. We saw our first bank issue a sustainability-linked bond just a month or so ago, metals and mining. So you can see a lot of diversification there, and not just by sector, but by other areas as well. So for instance, roughly a third of SLBs that were issued since last summer have been in the non-investment grade space. Roughly a quarter have been from emerging markets. So diversity in SLBs has really opened the door to a new sort of class of company or organization coming into sustainable debt. And for investors as well, I think they've embraced that diversity as well. It reduces concentration risk in their portfolios when they're thinking about green or sustainable outcomes. And it also allows investors to reach and engage and help finance the transition of a broader suite of sectors as well. So I think overall that is positive. And in terms of some of the targets that we're seeing in this space, you can see on the right-hand side that most KPIs to date have been around greenhouse gas emissions. And we expect that to remain the case. Patrick talked about this sort of collective ambition on net zero earlier, and SLBs are a great vehicle to embed net zero plans into your capital plans. But we've also seen some other areas, whether it's gender or biodiversity, waste and water management, where companies are putting out specific KPIs that they want to deliver over time. Now, that also reflects a challenge in this market, which is how do we ensure that KPIs are measurable, they use consistent methodologies, maybe they're science-based or science-backed, that they have external verification, for instance, and we'll continue to see an evolving best practice in this space. And as an SPO provider in this space, we review many of these transactions, we're focused on, are there interim goals? Are the goals specifically linked to, are they relevant and material to the company's business and their business model? Is there transparency? Do we have less reliance on things like offsets and more reliance on concrete targets? So these are all issues that we look at when we think about some of these transactions. And maybe just briefly, I'll finish with a case study of a sustainability bond for which we at Moody's ESG Solutions, through our affiliate Vigeo Eiris, provided an external review on. So this is for NRG Energy that issued, in fact, debuted an SLB to the tune of $900 million just in November of last year. Very notable for a number of reasons, but first it was the maiden SLB issued out of North America, and also the first energy company outside of Europe to issue a sustainability-linked bond. So a landmark transaction in many respects. You can see it was a 7-year placement with a coupon of 2.45%. Let me talk a little bit about the KPI. So there was one KPI that was provided, and that was around reducing absolute greenhouse gas emissions. And it looked at both scope 1 emissions, scope 2, and scope 3, albeit limited to employee business travel. And those KPIs were linked to a sustainability performance target that looked at decreasing greenhouse gas emissions by 50% over the next 5 years compared to a baseline from 2014. And in terms of the structural features, NRG Energy embedded into it, well, if they don't meet those targets, or if they're not on course to hit those targets, there'll be an interim coupon step up of 25 basis points as well. So when we looked at this particular transaction, we looked at the KPIs. Were they material for the sector? Were they above business as usual? And we believe they were. We also looked at the transparency. There was a consistent methodology. So the emissions forecasts were underpinned by science-based targets, and they produced externally verified historical performance data as well. So all very much in line with industry best practice. And as mentioned, not only is there the structural feature of a potential interim coupon step up, but the issuer has also committed to reporting on the bond over the maturity of the bond, which again is actually best practice in the market as well. So hopefully that gives you a flavor of a really interesting innovation that we're seeing in sustainable finance. It's leveraging data to really, sort of scale up and crowd in investment into the transition. And with that, Patrick, maybe I'll ask you to summarize, and then we'll go into Q&A.
Great, thank you, Rahul. And we've covered a lot of territory, so we'll just do a brief recap here to hopefully allow questions to bubble to the surface. There's a Q&A box at the bottom of the window if you want to type in any questions that you have. We're happy to take those. But in terms of the themes that we focused on today, really this is a story about ESG investment, the ESG investment ecosystem, rapidly evolving. It's a growth story. It's a story also about innovation. And with that comes some of the challenges related to data, harmonization, and how we use that in our various approaches to analysis and assessing risk as market participants. And even with that, standardization is not enough. New models, risk measurements, techniques, and so forth really are a source of further innovation, certainly within our business at Moody's ESG Solutions and more broadly in the market. Nonetheless, data and performance measures will continue to really boost that innovation in the sustainable finance space. This concludes our formal remarks. Again, we're happy to take questions, and we do have a couple of questions that have come in ahead of time that we're happy to tackle and give folks a moment to perhaps warm up and add some additional questions. Rahul, I talked a little bit about biodiversity earlier on and the fact that is coming into sharper focus in the market. I wanted to see if you could share a little bit about how is that factoring in as an area for data specifically?
Yeah, interesting that we've had a question on biodiversity and nature more generally. So we're seeing many of the I guess ingredients that we saw for climate 5-6 years ago with nature and biodiversity. We're seeing investors increasingly engage on this topic, policymakers thinking about data indicators and disclosure. And we're seeing the market come together to think about reporting frameworks and standards as well. So I think it's a really interesting area, and let's not forget its importance as well. So nature conservation is critical for hitting our 2030 Sustainable Development Goals. The UN PRI estimates that around 80% of the SDGs are reliant on biodiversity for successful delivery. So it really is important. Patrick, from the point of view of a data provider, it's a complex area. We know that businesses impact and negatively affect biodiversity and lead to biodiversity loss, but they're also dependent on nature and on ecosystem services. And so we're looking at innovative analytics that can help sort of better understand that relationship between business and biodiversity. So one of the key areas here is data. And data technology. So we have been working with remote sensing technology, things like data from drones or airborne lasers or satellite sensors to really get a higher resolution understanding of biodiversity. So just to give you one conclusion there, and we can share research after today's session, but we undertook some research that looked at some satellite imagery data to try and understand the potential exposure of company facilities across the world to biodiversity risk. And our information found that roughly 38% of company facilities globally have at least one facility that is associated with or exposed to biodiversity loss. So look, it's very early days in this kind of analytics, and we expect it to grow, but a really interesting area, and one I'm sure that will capture greater mindshare and attention going forward.
Excellent. And again, we're happy to circulate that research if anyone is interested in learning more. And I have a feeling that you're going to address indirectly at least a couple of questions that are coming in with this next point. The theme of social bonds, I think in particular that has received widespread attention, not only in terms of the volume of growth, but the various innovations and different uses, especially reflecting on the pandemic and how that's certainly led to tragic and challenging circumstances from a social perspective. Do you have any examples of innovation in that space that would be worth highlighting?
Yeah, absolutely, Patrick. So beyond SLBs, I think the sort of rise to prominence of social bonds has been, a key trend underpinning the sustainable finance markets over the last 12 months or so. We saw a 9-fold increase in social bonds from 2019 to 2020. And already this year, in the first quarter, we saw $90 billion of social bonds, rivaling the size of green bonds. And of course, the pandemic has been, in many ways, a catalyst there, building back better, building back more responsibly, thinking about the potential opportunity and need to invest in access to education, access to employment, have all underpinned this sort of boom that we're seeing in social bonds. At the heart of it has been the EU. The EU's social bond program has been huge and has been channeling funding towards, say, for instance, employment generation in Europe. But beyond employment, we are seeing innovation in other areas. So, for instance, empowerment of marginalized groups or gender, for instance. And maybe just to share a couple of examples. So, IDB Invest, the multilateral in Latin America earlier this year, issued a $1 billion social and sustainability bond, looking to really contribute to social impacts of SDGs in Latin America and the Caribbean, so very much with an emerging market flavor to it. And we also saw, related to that, Colombia's first gender social bond in 2020 as well. Really interesting transaction linking the bond to predefined outcomes on gender inclusion as well. So I think there's plenty of space for more innovation in this space going forward. And really highlights how the pandemic is shifting our market. And there's an interesting question that's come in, Patrick, around how did the pandemic change the way we collect ESG data? Like many companies, we've been, sort of working from home, working virtually with one another. And what I think, just to answer that question, the pandemic has done has meant that we have to rely on a hybrid model for data collection and data analytics. So not just analysts themselves, and we have many hundreds of analysts that are collating data, policies, measures, and really understanding what they mean, but also supplementing that with new technology, whether it's AI, whether it's models, to really get a holistic view of what's going on. And I think the pandemic, beyond the pandemic, will continue to use these sorts of models as well. And they really reflect changes, I think, that will take place in the broader economy going forward as well, more of a hybrid approach to activity.
Thank you. And I think that touches nicely on one of the questions that we did have about gender and how it's represented in our analysis. And certainly it depends on what specific assessment or rating or other tool we're using. certainly within Moody's ESG solutions. But examples would include, gender diversity on the boards of directors for entities. And related to that, we also recently published an infographic that highlighted sort of the gender-aware sectors in the U.S. facing fewer controversies. So when you look at the controversy screening that we do at Moody's ESG Solutions, there's some really interesting data that suggests that those companies with greater gender representation and policies that are supportive face fewer controversies. And interestingly, as you look at controversies, across the market, in the last year or so, a sizable proportion have been accounted for by gender-related controversies, whether that's pay disparity, sexual harassment, or other variables. So a very important theme and focus, not just for the bond sector, but more broadly. I do have another question about the data that we've had coming in, and where is it coming from, and will it be available? I'll just quickly say we've cited a fair number of different data sources. Some of it is Moody's ESG Solutions data. Some of it is data from third parties that MESG enriches or incorporates into various tools. So I think we'll make, I believe, the slides available, and certainly happy to have a follow-up discussion with the person who raised that question.
We've had a question come in, a really interesting one, about what is the relationship we're seeing between ESG data, reporting, scores, and financial performance. And of course, there's been sort of wealth of academic research in this area. But I just wanted to point out to our audience a recent paper that was published in February by NYU Stern and their Center for Sustainable Business. So it looked at over 1,000 sort of studies. It was sort of a meta-analysis that looked at the relationship between ESG and financial performance, and looked at different types of operational metrics, whether it was return on equity or stock price and other areas. And looking at those 1,000+ studies, NYU Stern found that there was a positive relationship between ESG and financial performance for around 58% of the corporate studies that they looked at. 13% were neutral, 21% mixed. Only 8% showed a negative relationship between better ESG performance and better financial performance. So really interesting there. And they also noticed improved financial performance as a result of ESG over longer time horizons as well. So there is a body of evidence and academic literature out there. But what I would say for any individual is, do your homework, understand what each ESG data or score is telling you, understand what's going into those scores, and really do your homework in terms of figuring out the linkage between ESG and enterprise value and cost of capital. And that's certainly what we're doing and what we're looking to do in our research as well.
Excellent. And let me see, we have a couple questions about regulation. Let's see, in terms of regulation, there's SASB, IFRS, EU taxonomy. Do you use any of those frameworks to evaluate the materiality of data you'll be collecting from corporates? And interestingly, on the theme of regulation, there's a question about what we see coming that could affect investors on the regulatory front.
Great. Yeah, I mean, Patrick, maybe I'll kick off on that. So in terms of how we think about frameworks, so our ESG data and scores that Patrick mentioned earlier, we really do leverage international reference texts and standards to really make sure we're asking the right questions to ourselves in determining ESG performance. And so within that, we do take into consideration accounting frameworks like SASB, like GRI, the Global Reporting Initiative as well. We also take into account the EU's taxonomy, which is of course still in flux, but that's something that we're looking at too. We also look at the SDGs and look at the alignment of company activities to SDGs. So yes, standards are very important. For the second part of that question, where do you see regulation going, essentially? So, for us, we're seeing an increasing focus on disclosure on material ESG issues. It started with climate today, and I think we'll probably expand into other areas like social metrics and data as well, and making sure we're talking a consistent language on social issues. We know that that's of interest in the US as well as in Europe. And we're also going from disclosure through to risk management frameworks as well. What's an interesting trend that we're seeing in the market is this concept of materiality and how that's evolving over time as well. So something that Patrick mentioned earlier was double or dual materiality. So looking at both risks to companies, but also the impact that companies are having on the environment and society in which they operate. The European Union has really sort of ingrained dual materiality into its legislative framework and regulatory framework. And we see the market more generally thinking about not just risk, but also impact. And so I think that's going to frame a lot of the sort of policy discussions going forward as well.
Great. Thank you, Rahul. And thank you, everyone, for your questions. We've really appreciated the opportunity to spend some time with you today. As Hallie mentioned at the beginning, I believe our website's links are available to explore some of the research and data and other information on our site. But thank you again, Hallie. Thank you to everyone at CGCC for inviting us and for organizing the event today.